This video contains excerpts from a tax policy symposium titled The OECD Base Erosion and Profit Shifting, or BEPS, Project, a blueprint for ensuring tax responsibility by multinational companies. It was presented on March 31st, 2016 at Washington State University in Pullman, Washington, presented and co-sponsored by the Hoops Institute of Taxation Research and Policy and the Thomas S. Foley Institute for Public Policy and Public Service, in collaboration with the WSU Carson College of Business. I'm Jeff Gramlich, Professor and Director of the Hoops Institute for Taxation Research and Policy at Washington State University. I'll be introducing our speakers and moderating the panel discussion that ensues. Our first speaker today will be Kimberley Clausing, Professor, and Thormund A. Miller and Walter Mintz, Professor of Economics at Reed College in Portland, Oregon. Our second speaker will be Reuven Avi-Yonah. Dr. Avi-Yonah is the Irwin I. Cohn Professor of Law and Director of the International Tax LLM program at the University of Michigan in Ann Arbor, Michigan. Our third speaker is Leslie Robinson. Dr. Robinson is an Associate Professor of Business Administration at Dartmouth's Tuck School of Business in Hanover, New Hampshire. And our fourth speaker is Chris Faiferlick. Dr. Faiferlick is an Ernst Young LLP principal and the leader of EY's Financial Services Transfer Pricing Practice in Washington, D.C. If you're not entirely familiar with transfer prices and the tax issues that arise, now would be a good time to brush up. Andrea Honig has graciously taken the time to develop a video that explains the issues. The link is provided on this slide and should also appear in the notes to this video that are shown below. So let's get started. Our first speaker is Kimberley Clausing, who will be speaking on the background and magnitude of the problems that gave rise to the OECD's Base Erosion and Profit Shifting Project. Kimberley?
Well, thank you for having me. I am ready to go if you are. I'm happy to be on this panel. I'm sorry that I could not be there in person, but I'm happy to be here virtually, assuming that all the technology works out. As you can see from my first big slide here, one of the big issues that the OECD and the G20 had to grapple with in this BEPS initiative was figuring out how big the problem was that they were trying to solve, but also whether if they came up with solutions, they would be able to measure and target the progress that they had achieved so far. So in order to do this, you need to have some understanding of what data you would use to evaluate the size of the problem and whether the problem was improving, what metrics you would use, and so on. And Action 11 was the part of their proposal that really addressed that issue. Next slide, please. So I've argued elsewhere, and I will briefly summarize here, that this is a large and pressing problem, and this problem can be seen if you rely on either a simple stylized facts or if you look at more elaborate econometric analyses. Looking at the simple facts, there's a host of simple indicators that indicate a large-scale profit shifting. As an example, U.S. multinational firms have about $2 trillion in permanently reinvested earnings abroad. U.S. affiliate profits are many times the multiple of the GDP of some of these small tax haven countries in which they're booking their income. So, for instance, in the case of Bermuda, 16 times their GDP. In the case of Caymans, 20 times their GDP. There have been a host of news stories and public attention that have focused on particular companies, like the Starbucks example, but also many others. And most of the evidence, both by economists, accountants, and lawyers, indicates that this is sort of a large-scale problem. Next slide. If you look at multinational firms and where they book most of their profits. What I've shown you in this picture are the top 10 countries in terms of where U.S. multinational firms book profits abroad. And of these top 10, you'll see immediately a sort of strange pattern that most of them aren't really big countries, but rather small tax havens. So Netherlands, Ireland, Luxembourg, Bermuda, Switzerland, Singapore, and the UK, Caribbean islands are 7 of those 10. And together they account for 50% of the profits booked abroad by U.S. multinational firms, but they're just 7 small countries who together have a combined population that is smaller than that of Spain, or if you prefer a domestic analogy, it's smaller than that of California. Next slide. So what I've done in some of my research is estimate how this artificial shifting of profit abroad is affecting U.S. government revenues and also revenues in other countries that aren't tax havens. And you'll see in this picture that my estimates of revenue loss are increasing dramatically over time, starting in the late 90s, but really accelerating to the present day. And estimates indicate that for the U.S. Treasury, this is costing in the neighborhood of $100 billion a year at present, if you sort of extrapolate these out a couple more years. And if you include other countries that are not tax havens, you get a number that's closer to $300 billion a year at present. So these are large revenue losses. Next slide, please. So if you look at how we're losing this revenue and where it's going, one thing that's immediately apparent from the data is that there are just a few countries that are responsible for sort of receiving a bulk of this profit shifting activity. So if you return to those 7 that I mentioned before, those account, in my estimates, for 82% of the revenue loss. And basically what I do in this analysis is try to estimate of the income earned in particular affiliates, how much of it is there artificially. So to take an example, if you look at Bermuda, U.S. multinational firms book about $80 billion in Bermuda. I then do an econometric analysis that estimates what that profit would have been, accounting for other factors in Bermuda, such as the scale of activity there, the GDP of Bermuda, the year in which the data are collected, and so on. And then I estimate that absent these income shifting incentives, profits in Bermuda would have normally been more like $10 billion instead of $80 billion. Now that $10 billion, to give you a perspective, is probably still too high if you just compare it to your gut instinct, because Bermuda is an island with 60,000 people. There's not a lot going on there. So having $10 billion worth of profit is sort of an extraordinarily large amount for just affiliates of multinational firms from one country. But it does tell you that probably a good chunk of that $80 billion is not really meant to be in Bermuda. So, of course, not all of that excess income is going to show up in the United States, so I then make assumptions about what fraction would be in the U.S. in order to figure out the revenue loss here. I guess that fraction would be a little under 40% in the most recent year, reflecting the fact that U.S. multinational firms do activities across many different nations, so not all this excess income is going to come back to the U.S. government. But nonetheless, if you account for some fraction of that ending up back in the U.S., you'll see that those 7 countries with those low tax rates, and their average effective tax rate is well under 5% for those 7, account for 82% of the income shifting problem. And if you add in the other countries under 15%, you get up to about 98% of the problem. And I titled this slide that it's a nonlinear problem, partly in honor of a group of economists at the JCT who have estimated this problem using tax return data, and they also find that the bulk of the income shifting activity is occurring with respect to low-income countries, and in particular the tax sensitivity itself is much higher with respect to those countries than is with respect to other countries. Now this analysis has implications for the data that we use to measure BEPS. What I use is survey data based on multinational firms. Next slide, please. But and what those JCT economists use is tax data, and those are both forms of data that the OECD has recognized in their Action 11 items as being best practices forms of data, in particular data that are likely to reveal the underlying profit shifting problem. But some rely on financial data too, and while you can learn a lot from financial data and you can do a lot of nice analyses because of the rich detail at the firm level, one thing that the financial data are missing, and in particular in the Orbis data set, but also in some of the others, is detailed observations on income in tax haven countries. So if you look at their sample, doesn't tend to be representative. And so for this reason, using financial data to measure base erosion and profit shifting is going to miss part of the problem, just like the economist looking under the lamppost for their keys. There's an old joke. You find an economist and they're looking under the lamppost for their keys, and you ask, well, why are you looking here? Is this where you dropped the keys? And the economist says, no, I dropped them over there in the bush, but I'm looking under the lamppost because that's where the light is. And I think that's part of why people like using the financial data. It's very rich in detail, but it's missing the tax havens who are over there under the bush. One thing that the OECD and G20 project pointed out is that it's important to have the right kind of data to really measure this problem. Now, some have argued that this isn't that big of a problem, and one statistic that they point to is the relative stability of corporate tax revenues as a share of GDP. And if you go to the next slide, please, you'll see. Hello.
Yeah, I just want to point out we've got three other that we need to get in.
Yes.
Maybe you could take just a minute and wrap it up.
Yeah, that's about where I was anyway. If you go to this next slide, you'll see that corporate tax revenues are pretty stable as a share of GDP, and that has led some to think, well, maybe this isn't such a big problem. And if you look over the past 15 years, and if you go to the following slide, so on that next slide, you'll see that looking at revenues being a stable share of GDP isn't necessarily what you'd expect when, if you look over the last 15 years of this slide, just focusing on the rightward third of that slide, you'll see a dramatic increase in profits as a share of GDP. So we wouldn't necessarily expect revenues to be stable when profits have been increasing dramatically. And I'll just end with this next slide, talking about the larger role of the corporate tax. One thing that I think is important and laudable about this OECD initiative is that it attempts to sort of protect the revenues associated with this tax. And in the current environment, we need revenue because the alternative is to, raise other taxes or cut spending or increase deficits. There's also political support for this tax. But I would point out that especially in the United States, this is one of our only tools for taxing capital income. About 70% of capital income that's held by individuals or institutions is non-taxable at the personal level because it's either in a tax-preferred account or 401k or a pension or retirement fund or in nonprofit endowments like Reed College's endowment. And so one of our only abilities to tax this income at all is really in the corporate form, since so little of it is taxed at the individual level. More recent models in economics suggest that capital taxation can be optimal with realistic models. It can fall on rents, which can be a highly efficient thing. And it also helps us address distributional concerns because capital income is more concentrated than labor income. So I think the BEPS is an important project to sort of protect this corporate tax in that era. I had one more slide about policy reforms, but I will hold those for the question and answer period. But these are two solutions that might help you address the income shifting problem in a world where source is really difficult. I think the OECD recommendations total 1,900 and some pages, and the reason they're so long is partly because of the difficulty of defining source. So if you turn to some of these more comprehensive reforms, such a definition wouldn't be as necessary, but those are more long-run solutions, particularly formulary.
Great. Thank you, Professor Klausing.
Next up is Professor Reuven Avi-Yonah, who will discuss BEPS Action Steps 2 and 3 about hybrid debt equity instruments. You're on, Reuven.
All right, so I'm going to focus on just a couple of these BEPS action items because I think I've chosen them in order to illustrate what I see as the bigger, both the potential and the bigger problems of the BEPS project, some of which have been alluded to by Professor Klausing a moment ago, so it's a good link. Here we go. The ones I'm focusing on are Action 2, which has to do with hybrid mismatches, here we go. And Action 3, which has to do with reform of CFC rules, so I'll get to that in a moment. So basically, the idea is to neutralize the effect of what's called hybrid mismatches, which basically means, for example, that country A treats a payment as interest, which is deductible, and country B, where the recipient is, treats the same payment as dividend, which is exempt. So that's one example. Another example would be country A treats an entity as a corporation, country B treats it as a partnership or as a disregarded entity, and as a result, you get double non-taxation. And I will go into some examples in a moment. This, from the beginning, has been a major focus of BEPS, and this is in large part due to the European reaction to the US check-the-box rule, which is a rule that was adopted in 1997, and that the Europeans view as a way to enable US multinationals to shift profits from high-tax to low-tax European jurisdictions without having to pay US tax. So some of the original examples, for example, involve shifting profits from Germany, which is a relatively high-tax jurisdiction, into Luxembourg, which is a low-tax jurisdiction. So next slide. So this is the timeline, and I've put in both the OECD BEPS and the EU actions, which I'll get to in a moment. And what's important is that the final BEPS action plan, which was released in October of last year, says that the results will be implemented accordingly by countries that are part of the consensus, and the OECD will monitor the implementation. And we'll get to that in a moment, because I think to some extent that hasn't been done. So next slide. So the final report on Action 2 heads Part 1, which is about domestic law rules, basically changing domestic laws in order to prevent this kind of hybrid mismatches. And Part 2 has to do with changing the OECD model tax treaties and changing tax treaties in general. So if you go to the next slide, you'll see some of what I'm talking about. I don't know how much you can see this, but for example, the first example is a hybrid financial instrument where a payment is treated as interest in country 1 at the top and as dividends as country B. And if country B at the bottom doesn't tax a dividend, country A should not give a deduction. That's the recommendation. And the one below that has to do with payments that are disregarded, meaning they don't exist. So at the top, there is an entity treated as a corporation by both countries. At the bottom is an entity that's treated by a corporation by the country that's making the payment, but the other country treats that entity as a disregarded entity, as a branch, and since you can't loan money to yourself, they don't see the loan and they don't see the interest payment, and as a result, there is no inclusion. And the same idea happens with 3 entities at the bottom. Now, what's interesting about these last 2 in particular is that these are identical to the examples that Treasury gave back in 1998 as an abusive treatment of the check-the-box rule. And that's important because, as we will see in a moment, the effect of Action 2 has been very different on both sides of the Atlantic. That is, the Europeans see Action 2 as something that all the participants in the BEPS project are supposed to implement by changing the domestic law. The US sees this very differently. So I think we can skip the next slide, and let me just talk. Well, maybe I'll go to Action 3 first, and then we'll go to what happened, that is, how this was implemented. So Action 3 is about, so Action 2 is about essentially strengthening source-based taxation, and that has very distinct, specific rules that are immediately implementable and are supposed to be implemented. Action 3, on the other hand, was about strengthening CFC rules, which is our subpart F, that is the anti-defer rules, and that there was no consensus, so the result is that Action 3, the final report, is very soft and basically just recommends to countries to adopt best practices under Action 3, which are defined in the next slide by a series of building blocks, but there's basically nothing binding about any of this, it's just recommendations. Let's skip to the next slide after that. And then we'll skip to the next slide after that, the last slide. Okay, so here's where it gets interesting. The EU response to BEPS was to issue in late January of this year a series of recommendations, and those recommendations included something about CFC provision, but that's pretty soft in accordance with the final BEPS package, and hybrid mismatch provisions, and those are quite tough. That is, they are binding on all the EU if adopted, and they are supposed to be implemented and to implement all of these steps. Now, what's interesting about this is that the US is also supposed to implement those, and while there has been some progress in this regard on Action 2 in the context of the new US model treaty, which was just issued last month, that's going to take a very long time to implement because a model is just a model and we need to renegotiate the treaties. But what's important is that as a matter of domestic US law, there has been no movement at all to implement BEPS, and in particular, not to change check the box. Now, check the box is just a regulation, so in principle, Treasury could change it any day, but obviously it seems that they're not going to do that. And the reason that I say that is because back in December, the President and the Congress agreed to extend for another 5 years what's called the CFC to CFC payment rule, which is a basic way of incorporating the check the box provision in the Internal Revenue Code. So if you extend it for 5 years, pretty clearly for the next 5 years, you're not going to touch check the box. And that's a long period of time. So essentially the situation with Action 2 is that the Europeans are very serious about it and are implementing it, and we're not doing anything at all except in the treaty context, but nothing to do with domestic law. And in the Action 3 context, what's happening is that basically there was no consensus, so therefore nothing is happening. And I think that's a pity because, as Kim hinted at towards the end of her remarks, there are two ways essentially of addressing BEPS. One is to focus on the source country and to try to make sure that each country taxes what's earned within it at source, and that's a really difficult project that's going to take a very long time, and I think Mr. Faiferlick is going to talk a little bit more about that, but that's essentially the transfer pricing issue. There are solutions, but they're difficult. On the other hand, on the resident side, the solution is pretty easy, I think, and obvious. It's just a question of politics. And the solution is to abolish deferral. If the United States decided that it's going to tax its multinationals on worldwide income currently, and every other member of the G20 is going to do the same thing, then essentially the BEPS problem can be solved because over 90% of the large multinationals are headquartered in G20 countries. So this will cover essentially the whole field. And that's why I think that
Professor Avi-Yonah,
fundamentally, yeah, I'm about done. The mistake fundamentally that BEPS did was to focus entirely on the source and not on the resident sides of the equation, and that's the issue with the distinction between Action 2, which has teeth, and Action 3, which doesn't. Thanks.
Great. Thank you so much. So, Professor Avi-Yonah, when you were talking about the hybrid instruments and how it could be considered debt in one country and a return of capital or a dividend in another country, is that an example of nowhere income?
Yes, exactly. And we have actually seen these transactions with Canada where you had a setup where a Canadian company owned an entity that was treated as a subsidiary for Canadian purposes, but as an LLC, i.e. as a branch for U.S. purposes, and made a payment that was treated as deductible interest for the U.S. and as an exempt dividend for Canada, and we renegotiated the treaty with Canada in order to eliminate that. But that's a good example, and you get double non-taxation, you get lower income as a result.
Okay, thank you very much.
Thank you.
Professor Leslie Robinson will discuss country-by-country reporting in our third segment. You're on, Leslie.
The third key theme is increasing information flow from a taxpayer to a tax administrator, right? So there's a lot of information asymmetry between a taxpayer and the administrator. So that's basically what I'm most interested in about BEPS. And so the two action items that I was going to talk to you about were actions 12 and 13. And they're just about more disclosure. So action 12 covers mandatory disclosure of what are called potentially aggressive or abusive schemes. So there are a lot of tax planning strategies that are created and sold by investment banks and accounting firms to clients. And so unfortunately, many of the people that devise these schemes and sell them are much more sophisticated, sophisticated is the word I'll stick with, than the tax administrator. And so the tax administrator often can't keep pace with sort of what's happening by people at Goldman Sachs. And so they need the information flow about, what's happening in the promoter market, the people that are selling these schemes, what's happening there, and trying to get information about that as quickly as possible so that they can possibly close loopholes quickly, either legislatively or through some sort of notice, because the faster that the tax administration can shut down a loophole before 10 or 50 or 100 taxpayers adopt it, the easier it is for them to protect their revenue. Once 100 people are doing it, you have to now go and litigate every case, right? And that's much more costly than getting information about it up front and possibly making a change to the law before it's widespread. So that's sort of what the mandatory disclosure rules are about. I have more on that if you want to talk about it, but I'll go to Action 13. Action 13, again, about just improving information flow from taxpayers to tax administrators. Action 13 is about transfer pricing documentation. So documentation about what Chris talked about, and a really key component of that is something called a country-by-country report. So quickly, the way that's sort of the feature of Action 13 that is the most widely discussed. And what this report would entail would be for a multinational firm, they would have to report 8 data items by country. So it would be aggregated by country, and they would be things like revenues by country, profits, taxes paid, employees' assets, things like that. So there's 8 data items. Now, there are 3 key concerns about that report. That's a very new thing. The report would be filed in the multinational's parent country, so the country of the ultimate parent. So Pfizer does business all over the world, but they would deliver a country-by-country report to the U.S. because, well, they're not based in the U.S. much longer, are they? No. Excuse me, that was a bad example. GE. Okay, so GE would have to deliver a country-by-country report to the U.S. for all of the countries in which it does business. Now, the way that other countries will receive that information is by the U.S. sharing it with them. Okay, so there are 3 key concerns, and then this is my last slide. 3 key concerns about this country-by-country reporting. First of all is taxpayer confidentiality. Okay, so there's a reason that firms don't report country-by-country information in financial statements, for instance. They argue that there's a lot of sensitive proprietary information that can get revealed when they do so. So taxpayers are very concerned that in the transfer of this information from the U.S. to all of the other tax administrations, that the information will either be leaked, right, because of data security reasons, or that the tax administration in the foreign country will subsequently decide to issue it publicly. So they're very concerned about confidentiality here. They don't want the information to be released to the public. They're somewhat, getting used to the idea of it being shared with administrators, but not in the public. Just one other thing I had on my slide, last thing, is that this country-by-country reporting will impose, or some are concerned that will impose a lot of compliance burden on a multinational. Multinationals' accounting systems are not designed to consolidate or aggregate things at the country level. Even tax accounting systems aren't designed to aggregate things at the country level. They aggregate things at the firm level, they aggregate things at the business level, but when you start to have a company that does business in multiple countries, does business in multiple industries within the same country, has hundreds of entities in the same country, it's going to put a big stress on their accounting systems to report by country. And just as one example, someone had mentioned to me that one of the big accounting firms was implementing a new information system for a big multinational to deliver this report, and the initial cost was $4 million to alter their internal information system to be able to provide this information. So that's just sort of one example that I've heard about the potential compliance burden involved. So I'll leave it at that, and we can talk about any of those things in more detail.
Chris, you're next. Would you be willing to share your thoughts about the base erosion and profit sharing problem and your opinion about whether the project was needed in the first place?
So I don't know if you guys follow the news, but if you remember a couple years ago, one of the ministers at the House of Parliament, Margaret Hodges, was upset that certain U.S. companies, namely Starbucks from Washington State, wasn't paying their fair share tax, and apparently they weren't paying any tax. And her question to the tax authorities, which was the HMRC, Her Majesty's Revenue and Customs, is how is this possible? Because as a layperson, she couldn't understand why a successfully branded company such as Starbucks wouldn't be paying tax in the United Kingdom for its shops around the country. And so the question came is, are companies artificially trying to avoid tax? And depending on what press releases you can see, one of the things that Mrs. Hodges thought was occurring was that the subsidiaries in the United Kingdom were paying excessive royalties to a related party outside of the United Kingdom, and that was causing the lack of taxable income in the United Kingdom. Because of this, this hearing and some other beliefs by civil society being organizations that are worried about or concerned with fair distribution of tax revenues amongst the people, amongst countries, et cetera, they thought that there may be a systemic underreporting of taxes by certain corporations in certain countries, especially those countries that have high tax rates, such as the US, Canada, and at that time, even the United Kingdom. And because of that, the finance ministers of the G20 got together a few years ago and asked, should we do something together to work together to make sure that companies are paying their fair share of tax? And based on that, the prime ministers, the presidents, et cetera, agreed to that. And because of that, they said, we want the OECD to lead an effort to figure out whether there is systemic underreporting of tax because of artificial tax planning or moving profits through transfer pricing or other structuring that is not economically based. And because of that, this base erosion and profit shifting task force, if you want to call it that, was created. And they focused on a number of things: transfer pricing, excessive interest expense for subsidiaries operating in a foreign jurisdiction, et cetera. When I used to work at the IRS, I thought, as a tax administrator, I thought there was some artificial gamesmanship going on. And so I think that the question's legitimate. I think the countries are getting together trying to reduce that, because the people who vote politicians in get frustrated when they think that corporations are not paying their fair share of tax, yet they have to pay their fair share of tax. And so the politics of this, if you will, I think is to make sure that companies are doing the right thing, just as people and your parents yourself are doing.
Our panel discussion begins now, and I'll start by asking questions to each of our panelists.
Some authors have argued that the BEPS project, this is a question for Professor Klausing, that the BEPS project was essentially forced onto the OECD by the U.S. because of the high statutory U.S. tax rate, the relatively lower effective U.S. tax rate, and its own government dysfunction. We know about that. To what extent do you agree with this view? Please comment. And we'll start with Professor Klausing, please.
Hi, yes, that's an excellent question. And I think that the U.S. has certainly played a big role in making this necessary, in part because of the incentives created by our tax system, which definitely encourage multinational firms to shift profits offshore. And some of our regulatory provisions, like the check the box feature that Reuven talked a bit about in his presentation, those sorts of features definitely heighten some of these tax competition pressures. But I would also note that I don't think we can solely blame the United States or its firms for base erosion and profit shifting. This is a more pervasive problem than that. Even a long time ago, the Europeans were interested in proposals to come up with a better way to define the corporate tax base in Europe because of concerns that firms were shifting profits away from countries like Germany and Italy and toward the havens within Europe like Luxembourg and Ireland. And I think that those sorts of concerns illustrate that this isn't a solely American problem, although certainly we've been unhelpful in terms of some features of our tax code, some features of our regulations, and also some of the leadership that our firms have shown in sort of inventiveness regarding tax avoidance.
Dr. Faiferlick, would you care to comment on this question?
Well, I agree with Dr. Klausing. I think Europe had a lot to do with it, between the UK with Mrs. Hodges and her hearings. Germany passed exit toll taxes long before BEPS came into fruition, and a lot of the BEPS stuff is based on the exit toll charges that Germany enacted. And so I think it's a number of things that are driving it, and I think a lot of it's just the frustration of the governments to enforce their own rules. I think some of the root cause could be changed, then we wouldn't have the BEPS problem. I think the BEPS problem is a result of a number of issues. I, for example, personally believe the United States, as a U.S. citizen who wants to get jobs in this country, and I'm not running for president, but I actually do believe you got to lower the corporate tax rate and broaden the base. Get rid of deductions, get rid of all the planning. And that would put me out of a job. But I think that is the thing that this country needs. If you want to stop the gamesmanship and you want to bring more jobs in here, I think that's something that the next Congress and the next president should take on. And I think a lot of these issues go away if you actually try to even the playing field on corporate tax rates around the world.
Given that we're fairly well invested in our careers, I suspect that based on your comment that you're not too worried about losing your job.
I'm not. I mean, I can do something else. I'll do immigration law.
Okay.
Again, I say that in a Pareto optimal sense. If I was a policymaker, I would think that's the better policy.
I agree. I would agree. I would agree with you. Professor Avi-Yonah, are you still there?
Yes.
Professor Klausing, Kim's recent 2016 working paper estimates that the U.S. government was losing between $77 and $111 billion annually by 2012, $280 billion for governments around the world. And the paper argues that that number is likely to have increased since then. Will the BEPS agreement help the U.S. start to collect some of its lost tax revenue? If so, what aspect of the BEPS will help most?
Well, I think potentially the answer is yes, but as was mentioned a moment ago, this depends on what we do next year after the election, and it's up to the next president and the next Congress to do something about it. Fundamentally, I think there is pretty broad bipartisan consensus in Congress that the corporate rate should be reduced. We now have the highest rate in OECD, and it hasn't meaningfully changed since 1986, whereas most of our trading partners have reduced their rate significantly. And we also have this massive incentive to shift profits offshore, as was documented in Dr. Klausing's work. So I think that something like the proposals that former Ways and Means Chair Dave Camp and President Obama have come up with, which is essentially to have a minimum tax on foreign source income of U.S. multinationals, and to the extent that the foreign tax is below that, the U.S. will collect that tax currently, is not a bad solution, but that depends, of course, on legislation moving forward in Congress, and I hope that this will be our contribution to BEPS maybe next year.
Okay, thank you. Professor Klausing, do you have any additional thoughts on whether you think it's likely to help the U.S. gain some of this lost revenue from BEPS?
Sorry, I think most of what I would feel on that position echoes very much what Reuven was saying. I think it's up to the U.S. government to decide what approach they want to take to these BEPS proposals. And so far there's been some intransigence about some of the details, and I think we could probably do a little bit better on that. But I think more fundamentally, an approach like the Camper-Obama administration proposals for minimum tax, or some of the other proposals to just end deferral and lower the rate, that kind of thing, I think would be a more fundamental solution to getting those revenues at some degree of the scale that I document there.
What do we mean by deferral when it comes to U.S. multinational companies? And what other options are possible?
Simply put, I would just say that, you know, presently we have a purportedly worldwide system which some types of income are taxed currently when earned abroad, like subpart F income, but much of the income only gets taxed upon repatriation. And one option would be to say tax all the income currently, but to lower the rate substantially so that in combination you weren't, you know, crippling firms with foreign income, but you would combine a lower rate with a current taxation. And there are precedents under purportedly territorial systems that argue that they don't tax the foreign income by label of their multinational firms. But if you look at France or Japan, for instance, they don't tax normally the income earned abroad, but they will if it falls under some rate, perhaps 20% or some fraction of the French level, for instance. And when they do that taxation, they tax that income. Currently, they don't let it accumulate abroad tax-free, and that dramatically reduces the incentive to earn income in tax havens if you have serious base erosion measures like those.
Chris, do you believe BEPS has already had an impact on firm behavior? And if so, how?
I think BEPS is having some effect already on some corporations who don't want to be named and shamed. I will tell you that many boards of directors never cared about taxes before. And the sense I'm getting is a lot of tax departments have to brief their boards of director about country-by-country reporting and if there's any anomalies about excess profits in low tax havens. And I think some companies, not all, but some are taking corrective action, if you will, because they want to be viewed as responsible corporate citizens. I think BEPS illustrates how a collective action that's really pushed hard and socialized, if you will, can have an effect. So, again, it's not going to change things overnight, but I see a trend towards more thoughtful thinking, if you will.
How does the ratification process for BEPS work? We know that the representatives of 31 OECD countries signed the BEPS treaty in January 2016. It was agreed on in October. According to Action 15, the agreement only becomes effective upon a country when that country ratifies it. What is the likelihood that a majority of the 31 countries will ratify BEPS? And when? And more important to us, what is the likelihood that the U.S. will ratify it? And when?
Reuven hit on it earlier. Except for country-by-country reporting, the information return, nothing is going to get done in the U.S. in the short run. As you know, President Obama can't get anything passed in the Senate. He can't get bilateral treaties done, let alone multilateral treaties. He can't get a nominee to the Supreme Court even considered. So that nothing's going to happen on a multilateral basis. I think the EU is going to adopt some of the BEPS provisions, and that's going to bring in 12, 13 countries immediately. Australia is going to follow suit, and you have other countries that are going to follow suit. I think China is going to do something. So there is pressure for the momentum to get this going, recognizing some countries will not adopt all the provisions. I think Canada came out with some provisions in their budget last week. So I think the U.S. is going to be the slow horse, if you will, in this race, and I don't know how they're going to do this. I think, again, Reuven mentioned about international tax reform. I think some of these issues will be resolved in the international tax reform if it gets teed up next year with a new administration. I think, Reuven, do you have comments?
Reuven, do you have any comments about that?
Well, I think you're right. That is, there are things that can be done relatively fast if we get some kind of tax reform. I mean, there's a broad consensus, and the shape of U.S. international tax reform, at least, has been clear for a long time, although it's not easy to do this because, for example, as you know, most U.S. business income is now earned outside Subchapter C, the corporate tax code, and as a result, if you do just international tax reform that cuts the corporate rate, you leave a much larger disparity between pass-through income that's taxed at high rates and non-pass-through income, and so all the hedge funds and the other businesses that are not paying the corporate tax object to a corporate tax reform that just cuts the corporate tax rate, and we'll see how that gets resolved. But if there is some kind of package that can pass, I think this will go a significant way towards implementing BEPS, at least from a U.S. perspective, and I also think that some of the other large economies, especially in the G20, less so in the OECD. The OECD with 31 countries is very diverse, and it includes, of course, Netherlands, Luxembourg, etc., etc. But the G20 are all really large economies, and none of them at the moment have a corporate tax rate below 20, although the UK has announced its intention to go to 17. But they're kind of the outlier. So I think that they would actually welcome a move that will enable all of them to collect something more like 20% tax rate or something in the 20s from their multinationals. And that, I think, is the promise for immediate action on BEPS, whereas some of the other things that are pending are significantly longer term projects, including, the transfer pricing elements, the revision of that, and any kind of implementation of country-by-country reporting on a practical level.
Great, thank you.
Under BEPS, firms would be required to provide reports that include basic income and tax information on a by-country basis. This information would be shared among the signatory countries. In March 2016, however, the European Commission issued a draft proposal that would require large firms, those with total consolidated revenue of $750 million or more, to publicly disclose information about business activities. In response, the U.S. Treasury Department said it will not share its country-by-country reports with signatory countries that release this information to the public. What do you make of this, Chris?
I think the EU is making a mistake, to be frank with you. Leslie noted that earlier in her discussion. But if you are a EU-based multinational, pick Siemens, which is, I would call the comparable to GE. Siemens, under the EU proposal, would have to disclose all its information, and it would be made public. Under the US rules, GE would file with the IRS. But under our treaty provisions, we have a provision that says if we exchange information under whatever form to another tax authority, they have to honor our domestic privacy, which is called Section 6103. So you can't disclose, IRS can't disclose your information to the public, even if you're cheating on your taxes, or except for the instance where you are criminally indicted, that's a public form. No one can know about your information, and that applies to corporations as well. So I think the EU is making a mistake by jumping the gun, if you will. They need to, in my opinion, negotiate with the United States to make sure that they take this evenly, to be fair to all corporations at the same time. And frankly, the EU could sabotage the BEPS initiative by doing this, because I think companies are going to get very upset, and they may withhold filing if they think they're going to be at a competitive disadvantage. So I think it's an amazing thing to put out there when the U.S. is not going to be even close to being able to follow suit in the next few years. And again, I think the other people could comment, but...
Right. Professor Klausing, did you have any thoughts about this public disclosure issue?
I don't have the expert perspective on the legal aspects of this, but it does strike me that country-by-country reporting is a very important component. Partly, I think one thing that we could ask of multinational firms that would be helpful for the public discourse here is more information and more transparency regarding their tax practices, because while they will complain that it's a source of privacy for them to keep their tax practices secret and to make them part of their competitive advantage, I think in a way that itself is problematic, and that firms should be competing based on how good a product they have, how good their workforce is, what they have to offer the economy, not based on how cleverly they can dodge taxes. So in general, I would be for more transparency and more public information on these multinational firm tax practices, and that firms can just disclose what they're doing and compete on other grounds.
Thank you. Reuven, do you agree with Chris that the OECD is sort of shooting themselves in the foot by going out there without trying to negotiate with the U.S.?
Well, I certainly think that there is a potential that the whole country-by-country reporting process, which is the part of the BEPS that seems to be most practical and further advanced, could collapse if the U.S., for example, says that because of the risk of public disclosure, it will not share information about American multinationals with other OECD member countries. And I do think that this is something that should be negotiated. I want to say something about what the value of country-by-country reporting may be. So the issue with the publicity seems to be a concept that you use disparities between declared profit and amount of tax paid to a country in order to shame that company or to do something about it in the style of what was done with Starbucks in the UK. But I don't think that's the principal value of country-by-country reporting. In my mind, the value of country-by-country reporting is that it provides us or tax administrations with the information so that they can get a sense of how much value is created in each country, and that may ultimately lead to a revision of the transfer pricing rules along the lines of something like a formula-based profit split, meaning that each country will get to tax based on the real elements, the people, the assets, the sales that occur with it. And this is, of course, what the US states do now. And this is something that the EU has proposed in its Common Consolidated Corporate Tax Base proposal that has now been revived. And I think that to the extent that country-by-country reporting gives you that information, in the longer term, in the next 10 years, in the next 15 years, maybe this will create some real movement towards reviving a meaningful source-based tax on corporate income.
I have a question from the audience, and the audience's member is saying, how will BEPS affect transfer pricing APAs going forward? Will there be an increase in APAs, these are advanced pricing agreements, from corporations as a result of having BEPS? So for those of you that don't understand, an advanced pricing agreement is an agreement with the tax authority about typically what the transfer price is going to be. Is that correct, Chris? You want to comment about that?
Yes, so an advanced pricing agreement is a negotiation between the countries about how to split the global profit pie between themselves. U.S. is a major participant with the UK, Japan, Canada, Germany, etc. I have seen more APAs in the financial services sector pre-BEPS because of all the regulations that have come on them after Lehman Brothers. And the regulators are telling them how they can do business, and how they can do business is at odds with what the IRS and some of the tax authorities think they should report profits. And so they're going in to say, listen, we don't care how we divide the pie, but the regulators are telling us we have to do things differently than we did before. We want your blessing. And so I think BEPS will do the same thing. If there's uncertainty in how to value intangibles or how to do profit splits on residual profit, I think you're going to see more and more companies go in for advanced pricing agreements to get that behind them because they don't know how the rules apply.
Currently, there are a number of countries in which corporations transfer profits. If only one or two of these low-tax countries say, oh, we don't want to play the game, is that going to mess the whole thing up?
I can speak to it in terms of the part of BEPS that I know the most about, which is information flow. I definitely think it would mess it up. So part of increasing the information flow between a taxpayer and a tax administrator is, at the international level, is that tax administrators typically only saw a very small piece of the operations of a global company. And so I think part of BEPS, Actions 12 and 13, are about helping tax administrators see not just what's happening in their country, but seeing what's happening for a multinational in every country. Because without some context in which to observe what's happening in your country, there's no way for you to think about whether there's a problem or not. And so I think that unless they can see the whole picture, and that requires cooperation from everybody, I don't think it'll be as effective as it could be if all of the countries were cooperating.
Is there anything that we can salvage out of it if we don't have a couple of countries that are key to it? I mean, if there's is there anything that we still gain out of it? And I'll leave that open. Just chime in.
Add, I thought the OECD did an amazing job in the context of tax secrecy years ago. They couldn't force countries to give up their tax secrecy, but they went through a process saying, if you don't change your rules and try to help us reduce tax fraud, we're going to isolate you, not embargo you, but do an isolation. It was amazing how that was effective, and peer pressure got other countries to say, yeah, we got to stop doing this stuff. We can't facilitate drug laundering or money laundering for drugs and all this stuff. And so that was effective. I think in the context of BEPS, if it's principled and there's a rationale for it, you're going to see countries actually sign up for it. Bermuda, for example, is probably going to adopt country-by-country reporting because even though they have a low tax rate, next to zero, they have, in my opinion, a legitimate insurance and reinsurance business. They want to still be providing an opportunity for companies to have a global insurance business. So I think you're going to see at least Bermuda come to the table because they see an advantage of being part of the process, if you will.
Great. What real changes do you think are going to come out of this BEPS agreement, even within the next year, but more important over the next 5 to 10 years?
So, I think part of what the BEPS process is, and maybe I'm a little more pessimistic than some, but part of what I think this process is really important for is starting a conversation about how to address this problem, recognizing that it's a problem, taking the problem seriously, and starting an important international cooperative effort. I would be very surprised, I guess, if I did these estimates 5 or 10 years from now and I saw that those big losses due to profit shifting turned around and went the other direction and came down substantially in a noticeable way in the next 5 years because of this effort. But I do think this effort is still incredibly important because you have to start somewhere, and starting with the recognition that you have a problem and thinking creatively about ways to deal with it, I think is really key. I think partly what people will learn is that they might need to be a little bit more broad in terms of solutions down the road. And as Reuven pointed out, for instance, perhaps some of the information that we get from something like country-by-country reporting tells us more about where economic activities are so that we can move to sort of more heuristic measures of where value is and tax firms based on things that are less responsive to tax than a simple accountant designation of where the profit is being booked. So I view it as a positive development, but not something that's going to solve the problem quickly or substantially soon.
Professor Avi-Yonah, would you like to give us your take on what benefits or harms are likely to come about because of BEPS over the short and longer term?
So I think there's something we haven't talked about much, which is, and that's, I think, the most immediate benefit from BEPS. BEPS shows that at least the OECD and the G20 now accept officially that double non-taxation or nowhere taxation or zero taxation of corporate profit is not an acceptable outcome. That was not always the case. This is a relatively new phenomenon. And this is now incorporated in the OECD Model Treaty, which is kind of the model for the world, and it's likely to be incorporated into actual treaties because the preamble now says that the purpose of the treaty is to prevent both double taxation and double non-taxation. So this is, I think, a major step forward conceptually and practically. As far as going beyond the treaty to what requires changes in domestic law, I see this as a long and difficult process for the reason that was mentioned earlier, meaning that as long as we focus on source-based taxation, U.S. multinationals operate in 90 countries, all of these countries have to some extent to go along, that's going to be very difficult to achieve. As far as reform that is focusing on residence-based taxation, as I said before, most of the top 100 multinationals in the world are headquartered in G20 countries. There I see more potential for medium to, in the next 5 years, especially if the United States moves forward with some kind of international tax reform.
Right. And Chris, earlier we were talking, you were mentioning something about sort of the notion that in front of boards of directors, corporate responsibility, social responsibility is on the uptick.
Correct.
And that this is fitting into that. Could you maybe just talk a little bit about that, just real quick, because these folks are getting hungry.
Right. No, and I agree with all Reuven's points. I thought they were spot on. And to Kim's legitimate skepticism, I will tell you, at least in my experience, and it's anecdotal, that advisors, the Big Four, the law firms, are now talking to boards of directors about BEPS. So that's one thing that these tax or the board people know. Before, they would never want to talk about tax. They never cared. It was completely below the line. It didn't affect their responsibilities as boards of directors. Now they understand that they have a responsibility for corporate responsibilities, social responsibility, maintain the reputation of the firm, and they do care about this, and they're actually being briefed on country-by-country reporting first drafts. And they want to know where the outliers are, and they want to know if there's a legitimate explanation for the outliers. And in some cases, I know there's being behavioral changes to fix those outliers, whether they look bad or they are bad.
When you mean outliers, what do you mean by an outlier?
Let's take, for example, you have 2 people in Luxembourg and 10% of your global profit. Unless you are reinsuring the entire operations, it's probably too good to be true. Now, I just made that number up.
Right,
But that is an
something
outlier.
very extreme like
Right.
that. Okay.
But there are extreme examples that corporations, some say they didn't know about, some knew about, and they're fixing. So I do think BEPS is changing behavior slowly. And I think to Reuben's point, it's going to take a few years to unwind some of these policies. But I know some companies are unwinding some of their structures to deal with BEPS because they don't want to go through the pain and suffering when it gets audited, especially after country-by-country reporting. It makes it more transparent to all the tax authorities.
Thank you very much. Leslie, would you like to comment about what you see as the real changes going forward?
Yeah, so my biggest concern, I think, is that I think there's going to be a lot of over-disclosure. I think there's going to be too much information coming at tax administrators over the next 3 to 5 years. I don't think they're always going to know what to do with the information that they're getting. So I think that process is going to have to play out. There's going to need to be some additional resources. People are going to need to be trained. I mean, tax administrators are going to look at country-by-country reports. They're not always going to even know how to analyze the data. So my concern is just that there's going to be a lot of great information out there, but people aren't going to always know what exactly to do with it. And when you don't know what to do with it, you can misuse it. So that's another concern that I have is I think some of the information might not be used properly, and that may cause undue burden on firms as well. So.
This concludes the panel discussion on the OECD's Base Erosion and Profit Shifting Project held on March 31, 2016 on the campus of Washington State University in Pullman, Washington. We extend a very warm thank you to our distinguished speakers, Professor Reuven Avi-Yonah from the University of Michigan, Professor Kimberley Klausing from Reed College in Portland, Oregon, Dr. Chris Faiferlick from Ernst Young, and Professor Leslie Robinson from Dartmouth College. We also want to extend a very warm thank you to our sponsors. Jointly, they are the Hoops Institute of Taxation Research and Policy, the Thomas S. Foley Institute for Public Policy and Public Service, and the Carson College of Business, all at the Washington State University in Pullman, Washington.